All right, welcome back to the Double Play channel where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy to invest in real estate. If you've been searching the internet looking for information on investing in real estate using life insurance, you've come to the right place. So be sure to bookmark this channel, subscribe to this channel so that you're notified whenever I come out with any new videos. All right, so today we're going to be talking about how to save an old lapsing universal life policy. And this is important because many of you may know somebody, a family member, relative, friend, who purchased a permanent life insurance policy, specifically a universal life, back in the late 80s, early 90s, when interest rates were super high and the projections were run at those high rates. And these policies today are running out of money, burning through the cash value because they never saw the growth that they were expected to see. So we're going to be talking about how we can save those. So if this sounds interesting, stick around after the intro and we'll get started. All right, thanks for sticking around. I'm Tomrutkowski with Innovative Retirement Strategies, and this is the Double Play channel. I created the Double Play channel because I know how hard it can be to find information online about investing in real estate using life insurance. A lot of websites have lots of pretty pictures and fluff, and they tell you that you should invest like the Rockefellers, but you have to talk to one of their high-pressure salespeople before you can learn how that's exactly done. So my goal is to give you as much information as possible free. My goal is to answer all of your questions so that you don't need to talk to a life insurance agent until you're ready to take some action, see what the numbers look like for yourself. If you do have any questions that I haven't addressed in all my videos, be sure to post them in the comments down below. I always keep on top of the questions, respond quickly, and my answers will provide benefit to anybody that finds those posts or reads the comments later on. So before I get started, let me go over a little bit of housekeeping items. Just want to let you know that all of this content is purely educational. There is no tax advice, no financial advice, no legal advice being offered. And the primary purpose for life insurance is for the death benefit protection. Any other benefit is purely ancillary. All right, so today we're going to be talking about how to save an old lapsing universal life policy. And as I stated, many of you may know somebody. So this is a little bit off topic for the double play, but it is important because many of you may know somebody who has an old policy, and it is possible to save those policies, or at least save the cash value of those policies. The death benefit is probably gone unless that person can afford to put a lot of premium into the policy. All right, so the goal of today's presentation is to show you how you can preserve the remaining cash value in an old universal life policy and keep it from lapsing. And the way I'm going to talk about that is to give you a little bit of brief life insurance 101. And I should stop here and just add that I put a link in the description box down below for a free ebook called Life Insurance 101. And I highly recommend, if you haven't downloaded that, to follow that link and download that paper. I mean, that'll provide a really good fundamental knowledge of how permanent life insurance works so that you can understand some of the detail in my video. In today's video, I'm going to provide a little bit of what I call brief life insurance 101, just a higher level and just enough to understand what I'm talking about, so that if you're coming to this video having done a search and you've never watched any of my videos before, so that you don't have to go back and watch everything from the beginning. After that, I want to talk or give you a little bit of a history lesson on universal life, so that you understand the context of why those policies are running out of cash and why the cash value never kept up with what was necessary in the policy. Then I'll get down to the nitty-gritty of how to save the cash value in an old lapsing policy. And then if you know me, I mean, I can't help but take an opportunity to bust some myths. And then I just want to spend a few moments talking about the universal life indexed universal life outlook for the future. We seem to have hit a turning point where interest rates are starting to rise. So I want to talk about the implications of rising interest rates on universal life looking forward. And then I'll wrap things up. All right, so I always like to begin any discussion on Life Insurance 101 by just using this graph of a minimally funded life insurance policy to explain the various piece parts of life insurance. And what this is showing is the cash value in blue and the death benefit in orange. So what we have here is a policy with a $1 million death benefit. That's represented by the orange line going across the top of the graph at the 1 million mark. And it's important to understand that the cash value is essentially the policy owner saving up the death benefit for the insured over the insured's lifetime. So if you think about it, if you put yourself in the position of the insurance company, they know that they're going to have to pay a claim someday. So the premium needs to be such that if they save a little bit every month, basically that policy owner is going to save up the death benefit. And that's represented by the blue line that intersects the death benefit out near age 115 or so. But you can see that essentially a permanent life insurance policy is just a transfer of risk over the insured's lifetime. If you look on the far left of the graph at age 45, you can see that the cash value is very low, near zero. The scale doesn't show the small amount of cash value at the very beginning of the policy. And the death benefit is very large. So all of the risk from at policy inception is on the insurance company. But if you look outward to, say, age 81, 82 timeframe, you can see that the cash value has grown and accumulated over time and now is at $500,000. And the death benefit is 1 million, so the risk to the insurance company is that additional $500,000. And I should point out here that it's really important to understand that the cash value is part of the death benefit. It's not a savings account related to the policy. It's not something that you'll get in addition to the policy's death benefit. It's literally you saving up the death benefit over the course of your insured's lifetime. So what you have here is again, it's a transfer of risk from the insurance company to the insured over the policy insured's lifetime. I'm sorry. And at the halfway point, there's just half the risk is still left. So an important thing to understand here is in a permanent life insurance policy, as the insured gets older, the cost of insurance does go up. Each year that you're closer to your life expectancy, there's a greater and greater chance of passing away. So the cost of insurance needs to be higher. But what this graph highlights is the fact that the amount at risk to the insurance company is going down. So the cost of insurance, yes, it's going up, but it's staying at a manageable level because the amount at risk is going down over time. And this transfer is engineered into the policy so that, given a set premium and an assumed worst case growth assumption, that policy will perform as expected, just like this graph shows. That there will always be enough cash value or interest earned from the cash value or premium to cover the cost of insurance throughout the life of the policy. Now, let's take a look at this next graph where we show that what happens when either the premium is increased or the rate of growth is increased. So here I've got a darker, bolder blue line that represents the cash value growing at a steeper, more accelerated rate because either the premium is higher or because the policy achieved better growth than what was projected. And one important thing to take away from this graph is that you can see that the insurance company has an incentive for the cash value to perform as best as possible. So the faster the cash value grows, the quicker their risk is eliminated in the life insurance policy. So I just want to stress again, the life insurance policy has an incentive, life insurance company has an incentive for the cash value to grow as quickly as possible. So now that we understand what happens when growth exceeds expectations, let's take a look at what happens when growth lags expectations, when interest rates decline, for example, below the interest rates that were either guaranteed in the policy or that were projected in the policy. And here we can see that the darker blue line is lagging the original cash value line. And if we just look out at the point where well, let's just say about age 101, 102, you can see that the darker new cash value growth line, the bolder blue, is intersecting the $500,000 cash value mark at about the 102, 103 year mark. The cost of covering that additional $500,000 is much higher at age 103 than it was on the original cash value line, the lighter blue, where it intersected the $500,000 mark at about age 80. And you can see that compared to the original cash value growth line at age 103, 4, whatever that is, that we've got about 3 times the amount at risk compared to the projected growth rates. So that additional cost of insurance that has to be covered because the cash value didn't grow at the rate needed is going to cause the cost of insurance to burn through, exhaust the cash value of the policy. So why am I telling you all this? So let's move on into the history of universal life. So this graph is showing you interest rates. This is the Moody's corporate bond yield for AAA rated corporate bonds for basically the last 100 years. And we can see here that there's an increasing trend from about 1950 until about 1982, 83 timeframe. And then interest rates began a decreasing trend all the way through the present, with the dip, it looks like it occurred around 2020, and now there's a little bit of an increase. And here we are in fall of 2022, and we're facing high interest rates, high inflation, rising interest rates, and high inflation. And so rates are definitely going up now. So back in the late 70s, those rising interest rates gave a tremendous incentive to insurance companies to develop the universal life product. And the thing about universal life is that it's flexible premium and flexible death benefit. And basically all the universal life is an unbundled whole life. So you're taking the same components, the cost of insurance and the savings mechanism, and you're just unbundling them and making the premium flexible and making the death benefit flexible. But what I want you to understand is a whole life is priced out on the basis of the guaranteed rate, which was 4%. And recently, when rates went down below 4%, they actually petitioned Congress to have the guaranteed rate lowered down to 2%. So all a whole life needs to earn over the life of the insured is at least 4% in interest for that policy to perform, so that you save enough cash value over the lifetime of the insured and keep up with the rising cost of insurance. So in a case in, like, say, the late 70s, when the guaranteed rate was 4% and policies were actually earning, say, 10%, the policy was credited with the 4% dividend, and then the rest of that was part of the dividend, that extra 6%. But that generally was considered a refund of premium. It was over what was needed for the policy. So it could have been refunded back to the policy owner, or it can be used to purchase paid up additions into the policy. So it grows the cash value at 10% as opposed to just the 4% that's needed for the contract. In the case of the universal life, what the product managers or product developers saw was an opportunity to use the 10% as the projected rate. I mean, you could price out a policy. If you assumed that a policy could grow at, say, 12% compared to the 4% guarantee, I know this is just simple math, but the growth rate is 3 times what it would have been before. So we would be in a situation where the cash value grows at a much faster rate. So we can decrease the amount of premium. Let me go back to that other graph so you can see what I'm talking about. In this case here, we can decrease the amount of premium, using the higher growth rate, and bring that bold blue line back to the original projected rate. So what companies saw as the opportunity was that they could sell a lot of death benefits for a much cheaper price than what they could beforehand. I mean, so universal life compared to whole life. Universal lives where you could buy much more death benefit for a much lower price at that particular point in time. But if we get back to the interest rates, now you can see what the problem was. That model was great until 1983. If you're projecting cash value growth rates of 10%, clearly the policy doesn't need as much premium as a whole life that's projected to grow at 4%. So huge advantage. But if you bought a policy in the late 70s, early 80s, and by late 80s and 90s, you saw the interest rates going down below what was projected, then your cash value wasn't growing as fast enough to keep up with the rising costs of insurance. So basically you found yourself, if we go back, you found yourself in this position where the cash value simply wasn't growing fast enough, so that it would generate enough interest, which when combined with the amount of premium coming in, should have been enough to cover the ongoing cost of insurance. So that is the problem with universal life insurance policies. They were projected using extremely high interest rates that were common in the late 70s, early 80s. But when interest rates started going down, the policy owners really should have been putting more premium into the policy to make up for the shortfall in the interest rates that they should have been earning. Alternatively, the life insurance agents should have been advising their clients that they should pay the premium. But I have a good feeling that some agents may have known they needed to do that, but a lot may not have totally understood the nature of universal life and the danger that those falling interest rates pose to the policy. And then finally, the insurance company would bear some responsibility as well. I mean, they should have sent warning letters or notifications to their policy owners to advise them that in this falling interest rate climate, that their policies were at risk of lapsing because the interest rates that were projected weren't achieved, and the policies needed premium to make up for that. But if you were a policy owner and the insurance company was telling you that your premiums were going up, would you have followed that advice, or would you have just ignored it? So in any case, a lot of universal life insurance policies began lapsing over the last 10 years or so, more than that. It's definitely a problem. So let's look at how to fix a failing universal life. So first off, leaving the death benefit high is just not an option without adding additional premium. And the problem here is, if you've let that policy go for a long time and you never achieved the compounding interest, it's going to take a lot of premium to make up for the interest that you never earned, or dividends that you never earned. Actually, it's interest crediting in the case of a universal life, not dividends. So all we can really do is try to preserve the cash value that's in that policy. So what you can do is, again, because it's flexible premium and flexible death benefit, you simply call up the insurance company and you convert that policy into a maximum overfunded life insurance, universal life. So what you're going to do is reduce the death benefit to the minimum non-MEC. And you don't have to remember that. Just call up the insurance company and literally tell them to lower the death benefit as much as legally possible. And once you do that, you'll drive a tremendous amount of cost out of the policy. Basically, the life insurance policy won't be purchasing any more death benefit than is what is absolutely legally required to meet the minimum definition of life insurance. And typically that results in an expense ratio, the cost of insurance, being about 1/4% of the cash value. And mind you, this varies by companies, but the companies that I like to use, that's the rate that they use. That's about the ratio that I see in their policies. All right, so this graph, you've seen a lot in a lot of my other videos, but this shows an example of one of my maximum overfunded policies, which is also known as a minimum non-MEC death benefit policy. So we're keeping the death benefit to an absolute minimum for the amount of premium that's being put in. That's what results in the maximum amount of cash value. So in this policy, again, the orange represents the death benefit, the blue represents the cash value growth, and the policy is being funded for 10 years. And at the end of 10 years, because the client would no longer be putting any more premium into the policy, we're slashing the death benefit to the absolute minimum to drive the cost out of the policy. So if you look at the orange line compared to the blue line in those first 10 years between age 45 and 55, you can see that there's an increment of about $2.5 million of death benefit that's just getting pushed up by the cash value. And then once the death benefit is reduced, we've just got a tiny little sliver of death benefit, which really represents the absolute minimum that has to be purchased to meet the definition of life insurance policy. And again, I just want to reiterate that ratio, the cost of insurance relative to the cash value, is typically about 1/4% in what I consider good companies. So that policy is in no danger of lapsing, because even recently, when interest rates were at their absolute lowest point, policies were still paying fairly high dividends, fairly high interest crediting. So 1/4% expenses, cost of insurance, is hardly going to risk lapsing the policy. Now, had that death benefit been kept high, we'd run into the same problem that we have with the historical universal life policies, is that the rising cost of insurance could be a problem and cause that policy to lapse, especially with only 10 years of funding. So point here, the reason I wanted you to see this is just to understand that that's what we will be doing to the universal life policies that we're trying to save, is reducing that death benefit to the absolute lowest possible amount in order to preserve the cash that's in the policy, so that it just doesn't get burned up paying for life insurance protection that is going to lapse in a few weeks, months, years. All right, so I also like to take this opportunity to do some myth busting. One of the things you'll often hear from people selling whole life only is that you shouldn't buy universal life or index universal life because the rising cost of mortality is going to cause these policies to lapse. As you can see from my little history lesson and my life insurance 101 here, the problem is not the rising cost of insurance. The rising cost of insurance is built into or baked into the policy from the beginning. I mean, they know what the cost of insurance, what the cost of any increment of death benefit is going to be 20 years out in the future, because they have actuarial tables. They know exactly how many people per 1,000 in a particular age group in a particular health class are going to pass away. So they can plan for that. They just need to achieve that minimum growth that they've projected. So when that growth doesn't happen, and that's part of the problem with the universal life, is you do have that premium flexibility. You don't have to pay that premium that you may have should have or would have with a whole life policy. People saw that cheap premium and how much death benefit they could buy. Interest rates were so high, they thought that that would last forever, but it didn't. So the real problem, the reason those policies are lapsing, was that the falling interest rates meant that the cash value didn't grow fast enough to keep up with the increasing increment of death benefit that needed to be purchased because the cash value was growing slower. When people tell you that the rising cost of insurance is going to cause a policy to lapse, that's just not true. Either they don't understand exactly how life insurance works, or they're conflating a minimally funded policy with a maximum overfunded policy. So again, what I've shown you here up above, those are what I consider minimally funded life insurance policies. Remember, the insurance company doesn't want to lose business by charging more for death benefit, right? So they're collecting no more in premium than they really need, given that worst case interest rate assumption that they use for that policy to survive over the lifetime of the insured. They don't want policies to lapse. So anyway, a lot of the people selling whole life policies have been seizing upon the failures of universal life in this case to position whole life against universal life. And unfortunately, a lot of people believe what they're saying and don't understand the difference between a maximum and a minimum funded policy and the historical aspects that I pointed out here. So in regards to the historical aspects, the one last thing I want to talk about is just the outlook for universal life and index universal life as of right now, fall of 2022. So the opposite conditions are in place today. So if we go back to the graph of interest rates, interest rates were rising from the 1950s through 1982. And if you bought a universal life policy during this time, it performed outstanding. I mean, your cash value would have been doing better and better and better until 1982, when interest rates started to fall. And once the interest rates fell below the growth rate that your policy was priced out at, that your policy needed, then all of a sudden you were having a cash value shortfall. Now, in the years from 1982, 83 to the present, ULs would have been doing worse with every passing year as interest rates fell. So as long as they were projected using very conservative low interest rate projections, even a universal life sold during that time would have done just fine. I mean, if you take a 4% growth rate, for example, the faint line at the just above the bottom of the graph it represents 2.5% interest. The next line up represents 5%. So 4 would be somewhere in between there. But if your policy was projected at 4, even with the falling interest rates, your policy still would have stayed alive during that time, and probably could have withstood the era where interest rates even got below 4. I mean, if you think about it, that a lot of whole life companies today, with interest rates below 4%, they were earning less than their guaranteed rate of return, or potentially earning. I mean, I don't know what they're investing in exactly. All I can do is look at their annual reports to see that. But, when interest rates fall below the projected growth rates, I mean, that puts the insurance companies in jeopardy because they're burning into their reserves to keep those policies in force. If we get back to this graph, the thing I want to point out is we appear to be back into a rising interest rate climate. So interest rates kind of hit rock bottom back in 2020. And with the change in administration and the policies that have been enacted, I don't want to get too political, but interest rates and inflation have both been rising for the last 2 years. And I mean, if things continue, I don't see any change in that, any getting back to the old. I mean, the only historical reference we have is to go back to 1950 and see what happened from 1950 to 1983. That was one sort of nonstop upward trend in interest rates until it got under control in 1982-83, and then they started falling again. So hopefully the government understands what they can do to get things under control again, and interest rates will start to go back down again. But the point I want to make is a universal life run with the low interest rate projections of today is quite likely to outperform if interest rates continue to go up. So, the thing that I really want you to understand about universal life compared to whole life is imagine a safe Cadillac, where the occupants are protected. There's lots of steel and padding, no airbags or seatbelts, but an old car like that is something that was safe and easy to drive. You didn't have to worry about accidents. Whereas universal life is more akin to a Formula One race car. And in the hands of somebody that knows what they're doing, it's a very powerful vehicle. You can do a lot of things with it. Having a policy back in 1983, for example, that you could buy for a third of the price of a whole life for the same amount of death benefit. If you understand what you're doing, that's an extremely powerful tool. You just needed to understand that as interest rates fall, you needed to put more premium in there. So hopefully you could afford to do that. But you also have the opportunity to create maximum overfunded policies, and there's just so much that you can do with the flexibility of a universal life compared to the restrictions of a whole life. With that, I just want to wrap things up and get to the conclusion here. So wrapping things up, I just wanted you to understand that the cash value of an old universal life policy can be saved by lowering the death benefit. I took a long and winding road to get to that simple statement, but I wanted you to understand the issues behind why universal life policies are lapsing still. And secondly is that there's no saving the death benefit unless the policy owner can add more premium to the policy. So with that, I'm done. If you're hungry for more information and you're not ready to talk to a life insurance agent yet, I highly recommend going out to Facebook and joining my Double Play group there. That's a community of like-minded people who are using life insurance to invest in real estate or just simply there to learn. And you're welcome to post questions to the group and ask questions. People can share ideas on what they're doing, what's working. If you have questions on how life insurance works, I monitor that forum pretty closely, group pretty closely. In addition, there's a ton of other YouTube videos that, again, my goal is to answer every possible question that as an agent I've received over the last, 10 years. But again, if there's something that you want answered that you haven't found, just post it in the comments down below. I'll post the answer, and that will benefit anybody else that has that same question and comes across it. In addition, there's pretty much a written version of every video posted as a blog on my website, and my website is just, again, full of information. I consider it to be a no fluff zone. It's not full of pretty pictures and nothing of substance. No, there's plenty of good, solid information to answer most of the questions that you should have about life insurance, and specifically maximum overfunded life insurance. And lastly, if you'd like to support this channel financially, you can go to buymeacoff.ee, and any support that you offer provides me an incentive to keep on producing these videos. So with that, I'll wrap up and see you in the next one.